Hello, Sector Watchers. Welcome to the show. This is a very special edition of Sector Spotlight, and I'm not going to number it because we should be able to play this again and again and again. And the reason for that is that I have actually my first ever guest on Sector Spotlight, and that is Charles Brown from Chicago. Hi, Charles.
Hey there, Julius. How are you?
To the show.
Thank you. I'm pleased to be a guest. I watch you every single week, and it's wonderful to be a guest and tell your viewers how I've managed to use RRGs in my process with my RIA and how it has really made an enormous difference.
Yeah, and that's actually you're jumping the gun here because I wanted to say that Charles is a real life example of someone who embraced the RRG technology. I think maybe six, 7 years ago, Charles.
Yes,
was that right?
Sounds right. That's exactly right. Yeah.
So we spoke briefly before the show, obviously, because we wouldn't dare to come in unprepared, would we? No?
Not a chance.
So, no, we are very prepared. So, so we actually we discussed a few things, and one of the things that I would like to hear from you, and actually, bring back my memory, which you did, is how did you run into RRG? What brought you to RRG?
So as a Bloomberg user, I had a terminal, actually got a second terminal. We had a tremendous year in 2013, which we thought was a tremendous year, up 34%. 2014 started, we were in this long-term bull market, but we just were not doing anywhere near the performance. And I said, there's got to be a different way to view this. Bloomberg had this charity auction, and there was this guy named Julius Kempenaer who was one of the people that you could bid on. And so I got in kind of a bidding war to get 1 hour of this fellow's time because he had this technology that was there on my Bloomberg terminal. And it just never made sense to me. But I thought, I need a fresh way to look at the markets. And I won the bid. And then I got my two CFAs on staff. And they got on the call. And another guy in New York I was using for some consultations. And we were all on here with Julius and said, tell us about this. And that's how it all started with you.
I think actually it was not a Bloomberg's auction. I think it was the CMTA's. It was a CMTA fundraiser.
Yeah, that sounds right. Yeah,
I'm sure the guys of the CMTA would appreciate that credit where credit is due. I don't think we need to fund Bloomberg anymore, would we?
Well, that's exactly true. But maybe there was some kind of cross promotion. But you're right. That's the case. And I had actually just gotten started getting my CMT and just realized that there's just technologies out there that I'm not using, and I wanted to be able to see more of the market in a simpler format where I could see things moving, and I was just really attracted to what was there, and my staff was. Now again, when you got CFAs, they're fundamentalists, and I always think of fundamentalists as funny mentalists. They hate it when I say that.
I love that one. I always use it.
I've used it before, and certainly guys like Tom are fundamental, and there are plenty of people at StockCharts that have that proclivity in addition to technical analysis. But coming from the commodity side where everything was just singular market, but managing equities, you really need to see where the sectors are. And you wanted to spotlight, if you will, which of the sectors are performing. I had to unlearn. Your technology helped me to unlearn things and then to learn them. One of the things that I unlearned was I don't need to be in all 11 sectors. Actually, when I started, there were only 10. And that was super important. Just discard the ones that are not performing and don't have a chance of competing and exceeding the performance of the S&P, if in fact you want to beat the S&P, which is the only reason we were in business.
Yeah, it's one of the things that I try to emphasize when I do presentations and when I talk to people, especially professionals, because people always asked in past tense, asked me, what are the best 5, best 3, best. They're always looking at the top. They always want to know what is the best. And I've explained it many times that I did some research, and out of that research came that it was at least as important, maybe even more important, to know where you should not be. Correct. And we're at the end of the year right now, and that's a period where everybody starts looking back at what happened and how their portfolios performed. And I always tell people, I'm 100% sure that when you look back, even in this year, 2020, which is a crazy year, but from a market's point of view, we are looking at stellar returns. But I'm sure that all of us, when we look back, we find 2, 3 positions of which we can say, oh my God, if I would have been able to just avoid those positions, I would have been off so much better. I mean, avoid the bleeders. And that was one of the basic reasons why I came up with RRG, because exactly what you said, I wanted people to show the whole universe, to be able to view the whole picture, the whole image, also where you should not be. So you picked that up rather well, I guess.
Well, I needed to. As I said, when I was doing commodities, we focused on singular markets, and clients would say, okay, well, if this is doing well, we're going to buy it. If this is not doing well, we're going to short it. Well, when I started in equities, for whatever reason, my client base was all qualified money. So these are, IRAs. Well, you can't short in an IRA, at least not in these states you can't. So I had to find ways to relatively outperform, or else I wasn't bringing them value. Well, so how do I do that? And how do I think of things differently than people like yourself who are, been doing this your whole life? Tom, been doing it his whole life. John Murphy. I'm relatively new at this. This is a third career for me. And just briefly for your audience.
Tell me about the first 2.
Well, so I wrote music for TV commercials. I actually am a classically trained percussionist and composer. I played Carnegie Hall when I was 17, which may sound really strange, but here's a little a tidbit for your viewers. Alan Greenspan, the former chairman of the Federal Reserve, PhD in economics, master's in economics. He started his undergrad at the Juilliard Conservatory, majoring in jazz clarinet, and he toured with Benny Goodman. So when I found that out, I thought, maybe I can bring something by just thinking of this as much as an art as it is a science, bring that to my clients, bring a level of confidence if I'm able to find a technology that enables me to see this whole market, which is something I didn't need to do on the commodity side. So after our call that day, you'd have no idea what a trajectory changer that was for me, because we all got off the phone. The CFAs were like, that was interesting, but my other technicians are going, we really need to check this out. So I started using it. I started showing it to my clients and saying, does this make sense to you? And the light went on, and it's just become an integral part of what we do, Julius.
You know what? Who's also a very gifted musician with a background in music? Dave Keller.
Yeah, right. And we haven't actually met, but I've seen his specs. I've sent him some links to my composer site. When my first symphony actually premiered in Chicago earlier this year, like 12 days before the whole city was shut down. And but it's a strange thing with music and math, how the brain works there. But you just try to use the skills that you've been gifted with at birth, and develop them in a way that can make money for people that maybe is different than what everybody else is doing. And your technology is absolutely part of that. Big part.
It's, what? I'm just thinking, because you're a musical background. Dave's got a musical background. I've got a military background, but so does, for example, a guy like Greg Morris have a military background. So we just have to conclude that everybody who's got either a military or a musical background is going to be damn good in technicals and stuff, because you can actually oversee. And I think I'm just making this up right now as we speak.
Sure.
I make that pitch with, military overwatch, high-level overview, what's going on your battlefield. I think I can make the same analogy to music, where you're is that called it? Who's leading the
conductor would be leading it. In my
exactly.
case, it's a composer where I'm putting together various elements to make a cohesive piece of music. you can argue that you're putting together a portfolio to make something that's cohesive to give you the best risk-adjusted return.
Yeah, absolutely. I love that. I love those analogies because it speaks for people. It actually makes sense, and it resonates with them in their minds. So after we spoke and we parted ways, what happened? How did you? I mean, I don't think you just like overnight implemented RRG in your process right then and there. But how did that go? How did that process go from that call to actually putting it into place in your workflow?
Sure. So I would say anytime I start something new, even though this is probably something that I shouldn't do, I paper trade it for a while. So I created immediately within, a few days after that call, a portfolio paper trading just on RRG signals. Now the Bloomberg implementation of RRG was not as elegant to me as there was another piece of software that I used in the interim. But when I picked up StockCharts, I think I've been with them now 5.5, 6 years, and saw the integration of charts plus RRG. I mean, I would not have gone with StockCharts had your technology not been there. Then I was able to do like the animation and things. And then I said, you know what, I think we can use this. So we picked a year. I think it was probably 16, where I said, we need to start making decisions, at least making this the secondary emphasis after basic charts and things like that. But by 17, it's absolutely my number one go-to. And then everything else plays out from there. And I can run through the methodology if you're interested. But
yeah, we're certainly interested to hear how you do that later on. So,
sure.
So first you paper traded it, and then did you then was there one day where you implemented it, or did you just gradually brought it into your process to get more comfortable with it?
Yeah. So as an RIA, and this is more on the business side, everything that we do, we trade at family money. And every client that we have trades our 4 programs. They don't necessarily trade it in the same weight that I do, but I'm trading alongside my clients, obviously in segregated accounts. It's it's an SMA model. But I traded, and they all know, like right now, I'm trading cryptos with your system, but none of my clients is. Now they're bugging me because they've seen my returns. I started with, 50 grand, and it's like 80 something now. And they want to jump in. I said, no, I've got to just make sure. Well, RRGs work. I know, but I haven't used RRGs with crypto. I just, give me some time on this. So that's how it works. You look at a technology, you paper trade it, you trade it with your own in-house money, family money, and then you say to the clients, this is what we're going to offer. Here's my track record. It's not 3 years, but do you want to do it? And some do, and some just stick with what I've been doing for, a decade.
So when you started doing that, because I watch your show every now and then, and I think what I like about the way you do things is you got a very structured approach. You go in and you always talk about politics, fundamentals, technicals.
And lately it's been COVID, obviously, because that's had effect. So yeah, those 4 areas for sure.
Yeah, talk us through that process, how you do that.
So I think I started in 2008 when clients came to me and said, you got to come out and talk to us. We are freaking out. And I'm not a public speaker, or at least I wasn't then. And so I just started doing these impromptu talks that I would call fireside chats, where I would say, well, here's what's going on. Guys, we've seen this before. You may not have seen it with me, but this has happened in history. I would pull up historical charts. Again, I didn't have your technology. I didn't have a way to compare, say, money's moving to different sectors. We're going to be fine. All they saw was their net lick going down. And then over the years, I've modified this for the video approach. But even this past year, my video producer came to me, my video producer, Tom, said, you need to go out on Facebook Live tonight. What do you mean tonight? It's like 4 p.m. No, I mean now. Well, I don't even know how to do that. Well, I'll coach you through it. You need to do what you've been doing with your clients, but you've got to tell them this whole pandemic thing, they can't freak out. And so that's what I did. And I started with these topics, structured just like your program, just different topics, but something that a retail investor would understand. That wasn't the time to talk to them about where the RRG is. But once things stabilized, obviously March 23rd low, Feb 19 high, Sep 2 high. I mean, we talk about those kind of technical points, but I think that it has helped the clients once. For at least 2 years, I would do my live presentations and put RRGs on the screen, and it was hard to even get them big enough to where they could, see the labels and everything. And they'd come up to me afterwards, it's like, I've been watching these for a year. I think I'm starting to get this because it's just the way you see the whole universe. I said, yeah, it's like 10,000 feet instead of looking right in front of a chart. And they're going, yeah, that's helping. And then when they see the performance, our growth program's up 56%, 56.2 as of before you and I got on the air. That's not a bad year, for a relative long only program. So
no, I think that's a very good year actually, especially in growth stuff. So so when you implemented that and you started talking about it, you got feedback from your clients? Did they say, hey, this is new, I have no idea what you're doing and what you're looking at, but it's good for me? Or did they want to learn more? How did they take it in?
I think mostly, again, on the retail side, they wanted to know how I was thinking, how I was changing my thinking, because my change of thinking was going to affect the outcome for their portfolio management. So this is where, reading John Murphy's materials, and we would start with top down. So which asset classes in which parts of the world are performing well? And if the U.S. is not even performing well, then we need to have EEM and EWG and other EWJ, other assets in there. And when they could see that, we're not just buying stocks in an account in a microcosm, and that this really is one world economy, and that our decisions needed to be based on that, I think they got excited and they felt more confident that we weren't just, quote, picking stocks, like in the 1920s when the market crashed. It's just, that part of it is more scientific. There's still an art, obviously, but being able to see everything on one graph and the circles rotating, and it just made a big difference to them.
So tell us how, because I know by now that there are many ways that people implement RRGs. I have my way of doing it, but I've come across people who use RRGs in ways that I thought, oh wow, that's a very interesting way of looking at things. That I'm learning new things. It's like I always compare it to some sort of Pandora's box. Not so much more every day, but at least once a month I open that box and something comes out and I go, oh wow, that's, hadn't thought of that.
Sure.
Very recently I started publishing RRG charts showing the number of COVID cases per country relative
I saw
to the
that.
world.
Yeah.
So that was one thing. I was like, oh, let's play around, and then wow, it works. But what I want to know, and I hope the people watching this want to know, is what are you looking for on an RRG? What are your points? What are your triggers? Because there are many.
Sure. So when I first started, I think my first thought is I want to buy a stock when it exits lagging and goes into improving, because that means it's automatically going to go into leading. Well, that's not true.
No.
So what you want to avoid are what I call these, and I don't use language that's nearly as precise as yours, but I call them dive bombs. When a stock goes into improving, then just goes, I'm making my eyes go down. It's like, what? You're heading back to lagging? You can't do that. What I've found is when you're about halfway to even 2/3 and heading due east or preferably northeast and improving, that's probably, and I hate to use the word safest or less riskier time to buy something. I'll still buy something after it's entered leading, especially if it's heading northeast, so the direction is really important. and even northeast is really encouraging for me. There are times I'll even buy something that's well into leading if the tail has been really fat getting in there. And I don't know if this is too techy for the people watching, but that's what I look for. Now, at the same time, I would be selling something in the early days the minute it crossed into lagging. And now I'm looking at the trajectory of that, because there have been plenty of times, certainly either at the stock level or the sector level, where what I call jackknives, I'm sure you call them curl ups, but you just see something head in and then just bam, it heads right back to leading. And when I see that, if I've sold, which at this point I really have not, or in the early days I did, it's like, yeah, I needed to hold that. I think overall, in the length of time I've been working, I've learned that I need to be more patient with these signals, and certainly the weekly signals mean way more to me than the daily signals.
Yeah, I think so too. Yeah, I mean, and I can see that from your approach and your business model. I don't think that in your accounts and in your programs you want to, very heavily trade or day trade or get in and out of positions. You want to have something stable. So you definitely need to look at a little bit longer term trends, and that's where the weekly RRGs come in. And I totally get it when you say you need to be more patient, and I had to learn that too, because what I found out when I started using RRGs, or well, it wasn't even RRG at that time, it was when I was working on the sell side as an analyst, and I had a very, very preliminary version of what now is RRG, and I always, because you were competing with a ton of analysts on the sell side, and you needed to to stand out. And so this was my unique selling point, so to say. This was what was setting me apart from other quant technical analysts. But what I also told them is like, hey, you don't need to read my email or my report, the minute it comes in. It should be valid at least for a week, maybe even 2 weeks. Sure. Because what I'm looking at is trends that are, 3 to 6 months out. And what I actually saw is that these trends, so that was my time frame. What I've noticed is that these relative trends, especially these relative trends, they very often tend to last much, much longer. They can go 12, 18 months.
Exactly.
Easily.
No kidding. It lasts longer than we expect.
The first two examples that spring to mind are technology on the positive side, stayed on the right-hand side of that graph forever.
And the other?
It's still there.
Sure.
And then on the other hand, energy, which is
sure.
like, I think we discussed on a YouTube video in a comment, will it ever get back to the right-hand side? So I think yes, but we don't know when, and that's exactly what you say. Those trends, they can last very, very long.
Couple comments. First thing is, when you and I were talking about that on the message board or whatever it was, that's when energy had a 5% week. So energy faded you and me. But here's one more technique that I've used, and probably just this year. I would say, since the big fall on March 23rd and then the ensuing recovery, clients would say, "Look, you can't stay in technology. You just can't stay in that." I'd show them the chart and say, "Well, technology's still over here leading, yeah, but look at what else is coming in from improving." And I would say, "Well, let's look at the constituents." And so, just in an immediate one picture, you can see, okay, we got XLK. The preponderance of the constituents in XLK are in leading, and there's some in weakening, not very many over here in lagging, and some are improving. So if my eye immediately goes to that green, that tells me that when I look at the sectors in an RRG, that I don't need to be concerned that sector is going to fail when its individual constituents, which after all are the ones that make the money, are still strong. And so I found myself sending these comparative charts, not to all my clients, because again, I'm a retail shop. 80% of my clients are not that technically interested, but the ones that are really want this and are hungry for explanations on how we're making the decisions. And that technique I just showed you, look at the sectors versus SPX. VBI and X, look at the sectors versus that too if you want. But then look at the constituents and see where they're tracking. And again, you don't need to stare at it for 90 seconds. In 5 or 8 seconds, you can see, yep, I still need to be there because these constituents are all doing well. Yep. And if you look at energy, you'd see those constituents way down there, and it wouldn't even matter where XLE was on the chart because the constituents are so weak.
Yeah, and then you mean putting the constituents against SPY, not against XLK or XLE.
You're correct.
Because then, yeah, exactly. Yeah, that's where you got that shift. You got that bias from the sector, and you'll see a few that are disconnected and inside lagging or somewhere else. But if you see the majority of a sector, individual constituents versus SPY, going in a general direction, that's definitely where you get a clue. Absolutely.
Yeah, and there are exceptions. I mean, I'm not picking on NE, but NEE is a utility that, obviously utility is not a growth sector, but it's something we've held all year just because it has been so strongly fading where utilities are. And we haven't found that yet for energy, but there will be those that become the breakout stocks that then can almost, if they're strong enough, pull the sector with them, and if they're a large enough market cap, obviously. But yeah, that's how we're using them. So,
Charles, we need to start working towards the end, but I've got one more thing or question. Have you, because you're an RIA, so I assume that for your funds and your clients, you need to have some sort of periodic reporting to them. So what have we been doing, et cetera, et cetera.
Sure.
Have you ever considered putting an RRG of your holdings in these reports?
That's a great idea. Most of my clients look at the online statements, and I'll, say all my clients clear through Interactive Brokers, and I would need to integrate that, which I could do. Why don't we do that for 2021? Let's make it a point to do that. I think that's a great idea, actually.
I've been doing that for a while, and I'm promoting it to people like yourselves because I think it's a great way of actually for them visualizing what they are actually holding in their portfolios.
Sure.
And for RIAs, it could be something because all these reports are super boring. And everybody gets them, and they're all tabulated, and got a lot of figures, and nobody cares. They just look at the first page. What's my return? And if you throw an RRG in there with your holdings, and you've got something to talk about, and you got something that sets you apart from the RIA competition, I guess.
Oh, absolutely. No, it's a great idea, and it's kind of one of those, why didn't I think of those? But yeah, and I would obviously I'd need to pull apart the standard report and insert that in there, but it should be page 2. Page 1 is obviously the returns. They want to see that.
Oh, yeah.
But how we got those returns is not a 10th page item. It's a 2nd page item.
Absolutely.
Yeah, I'm with you on that. So
it's it's all about the visuals and making people stand out because in this competitive world you need a few little things that get people towards you.
No question.
Hey, Charles, we're already out of time. I mean, I think I've got the feeling that we can do this more, and I'm sure we're going to get you back on
great.
Sector Spotlight on a regular edition, a little bit shorter, but I would like to thank you very much for this interview that we're going to play for the viewers on StockCharts television towards the end of the year. I wish you the very best and very happy holidays, and thanks for being with us.
You bet, Julius. You too. And I would just tell your listeners, if you have questions, CB3 at cb3.com. Happy to answer any more specifics on how we use it. RRG has been a huge blessing to us and to our clients. And as money managers, we just are so grateful that you exist and have this technology, Julius. It's just great, man.
Thank you, Charles. And that was it. This was Sector Spotlight. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Please stay safe for now. I wish everybody happy holidays and see you very, very soon.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.